Hello everyone. Today I am going to record this lecture, this video for exercise 18.3. That's chapter 18. We're starting with 18.3. 18.3. We're only going to do part A. I can do B too. Part A is telling us to calculate permanent difference and not calculate it to from each situation, and you need to indicate if this is a permanent difference or this is a reversing difference. And we're going to do one by one. So again, we're going to start with exercise 18.1, and our first part of the question is to part A. We're going to do part A and part B together. So we're going to answer part A and B together. So the answer to A and answer to B, and then for each situation. We're going to read the question saying that the excess, so the word is excess, the excess amount of a charge to the accounting records, which is the allowance method, over a charge to the tax return for the write down of inventory due to obsolescence. First, what we needed to know is this a reversing difference or a permanent difference. So the method for accounting is different from the method of writing your inventory for the tax purposes. So it's not that you're not going to pay, it's not deductible or it's not taxable. You're just going to pay the taxes in a different time of the year. So in this case, if you're going to be paying the tax in the different year, it becomes a reversing difference. So the answer to the first one is a reversing difference. If it's a reversing difference, then you needed to answer a question: is this a deferred tax asset or a deferred tax liability in the future? So in other words, if the amount will be deductible in the future, then it becomes a deferred tax asset. So the answer will be, it'll be a deferred tax asset. The amount will be deductible in the future. So if the amount will be deductible, then it creates a deductible, then it creates a deferred tax asset. Let's go to the second one and answer A and B for that. The word is excess. The excess amount of accrued pension expense over the amount paid. So we know that this is pension expense is an estimate, and it is a reversing difference. If it's a reversing difference, you add back difference and you add back what for the expense, and you minus what is paid, and the word is excess. So in this case, it's a deferred tax asset. If it's a reversing difference, you're going to have a deferred tax asset or a deferred tax liability. Now in this case, we are going to have a deductible. If you're going to have a deductible in the future, then it becomes a deferred tax. An asset. Let's see what the number 3 is telling us to do. So we could do number 3. Number 3 is the receipt of dividend. So the word is dividend from a taxable Canadian corporation. We know that we learned dividends. Dividend income is after tax income that is paid from one Canadian corporation to another Canadian corporation. And the question is saying is that are treated as an income for the accounting purpose, what not. The word is not subject to tax. If we're not going to pay any taxes, so it's not taxable, then it makes a permanent difference. So it makes a permanent difference. If it's a permanent difference, like I said, that do not create any deferred tax asset or deferred tax liability. So it do not. So the word is do not. So permanent difference, you do not need to calculate any deferred tax asset or a deferred tax liability. So then let's go to number 4. 4 is saying expense incurred in obtaining tax-exempt income. So there's some expenses that are exempt. So means you are not, they're tax-exempt income. So number 4, if it's they're tax exempt, means they're exempt from paying any taxes. In this case, it becomes a permanent difference. So permanent difference. Again, if it's a permanent difference, there is no deferred tax asset, no deferred tax liability. So there is no deferred tax asset or a deferred tax liability. So the part you need to, if you answer your question as a reversing difference, then you're going to have a deferred tax asset or a liability. Otherwise, you're not going to have a deferred tax asset or a liability. Number 5, a trademark that is acquired directly from the government is capitalized and amortized over subsequent periods for the accounting purposes and expense for the tax purposes. So the timing is going to be different. So the timing is going to be different. So if the timing is due to a timing, it becomes a reversing difference. So the answer to 5 is a reversing difference. So we needed to know, is this is going to be a deductible or it's going to be a tax. So so now we needed to know if there is going to be a deferred tax asset or a deferred tax liability. So in this case, we are going to have a liability and it's going to be taxable in the future years. So if the amount is going to be taxable in the future years, then it becomes a taxable amount. It becomes a taxable in the future. It becomes a deferred tax liability. So let's go to number 6 and see if you can answer C. It's saying a prepaid advertising. So it's a prepaid advertising expense that is deferred for the accounting purposes and deducted as an expense for the tax purposes. No, it's deferred. Anytime you're deferring something means you're not allowed to do it now, but you're allowed to deduct or taxable in the future. It becomes a reversing difference. So in this case, it is a reversing difference. You're going to take advantage of it or you're going to take a benefit of it in the future. So it becomes a reversing difference. If it's a reversing difference, then we have to ask ourselves, are we going to create a deferred tax asset or a deferred tax liability? In this case, it's going to be, they're saying it be deducted as expense for the tax purposes. So you're deferring it, so there's going to be a change in your accounting income. It will be taxable in the future. So then if it's going to be taxable, it creates a deferred tax liability. So let's go to 7. They're saying premium paid on a life insurance officer where the corporation is the beneficiary. Any life insurance premium, the corporation is going to benefit from the payout. If they're going to benefit from the payout, it becomes a permanent difference. So then we're not going to pay taxes on that. So it makes a permanent difference. If it's a permanent difference, there is no deferred tax asset and no deferred tax liability. So there's no deferred tax asset or deferred tax liability. There's a lot of them. So let's go to our next one. This is a good list because at the end of the day, when you are going to do your test questions or your exam questions, you make a list out of it. Which one is a reversing difference? Which one is a permanent difference? Now, number 8 is a permanent difference. They're telling it's a penalty paid for filing a tax return. So it's any penalty or fines, they are permanent difference because it's our fault that we did not report, we did not file our taxes on time. So it's our fault. The government say that this is not a deductible expense. So there's no deferred tax asset or deferred tax liability. So let's go to number 9. 9 is saying, now again, same thing. So this one was 7 and 8 are 7 and 9 are connected. In this case, a premium. So in this case, the expense we paid to the insurance company is not a deductible expense. Now they're saying proceeds. So any money we receive from the insurance company, we do not pay any taxes on it. So it becomes a permanent difference. So permanent difference. So if it's a permanent difference, there is no deferred tax asset or deferred tax liability. Let's go to number 10 and see what number 10 is asking us to do. So number 10 is saying restructuring costs that are recognized as a unusual item on the income statement but not deductible until actual. So we are allowed to deduct it but not till the actual cost. has incurred, so are not deductible until it's actual. So if it's going to be later on, in this case it becomes a reversing difference. If it's a reversing difference, we do have a deferred tax asset or deferred tax liability. So we needed to know, is this going to be deductible in the future, or it's going to be so it's, in this case it will be deductible in the future. If it's going to be deductible in the future, it is going to be a deferred tax asset, so it's going to be deductible in the future. Let's go to our number 11 and see what's happening with question number 11. So under 11 is unrealized gain and loss. Now, like we learned when we did our lecture, our chapter lecture, we learned it that unrealized gains and loss are not taxed till we sell that investment, till these gains or losses are realized. So in this case, unrealized gain or loss are recognized on the investment because the fair value of the investment goes up or down. So if it goes up and down, we record unrealized gain and loss. So now we have to record a realized gain and loss. So number 11, it becomes a reversing difference. So when you have a reversing difference, we have two things. We have a deferred tax asset, and we also have a deferred tax liability. So the question is, do we have in this case, do we have a deferred tax asset or deferred tax liability? Now, you could have both. In this case, the question is asking you unrealized gain. So in this case, if it's an unrealized gain, that it becomes a deferred. We needed to ask ourselves a question: are we going to be taxed in the future, or are we going to be deductible? In other words, gain, we're going to be paying taxes in the future. If it's a taxable amount, then it creates a deferred tax liability. So it's a taxable. The amount is taxable. Let's go to our next one. Next one is going to be 12. In this case, it's going to be the opposite of what we did in 11. So 11 in this case is an unrealized loss. So this is the opposite. So it is a reversing difference. If it is a reversing difference, then we have deferred tax asset and a deferred tax liability. In this case, if it's a loss, we are going to get an asset, so it'll be deductible. So it's a deferred tax asset. Number 13, let's do number 13. 13 is saying excess depletion of accounting purposes over the tax purpose. In other words, CCA and a depreciation. If it's a CCA and a depreciation, we know it's a reversing difference. So 13 is a reversing difference. So in this case, it is a reversing difference. If it's a reversing difference, we needed to know, are we going to have a deferred tax asset or deferred tax liability? So the word is excess. So depletion, depreciation is for accounting purposes, where CCA will be taken from the CCA for the tax purposes. Depreciation is for the accounting purposes. CCA will be taken for the income tax purposes. In this case, it will be deductible. If it's going to be deductible, it's going to be asset. So it's going to be a deductible. Then the next part of the question we're doing is 14. In this case, we talked about it briefly, gross profit on a completed contract and a percentage method. When that's the case, completed contract is recognized by the CRA. So in that case, it's 14 is also going to be a reversing difference. 14 is going to be a reversing difference. And we needed to ask our question: are we paying more taxes in the future, or we're going to pay less taxable? So it's going to be, we need to, if it's a deferred tax asset and deferred tax liability, in this case, we are going to have a deferred tax liability. So 14, we are going to have a deferred tax liability. It's going to be a taxable. Yes, and it's going to be a taxable.